Have you ever entered a trade only to watch price move against you? Or maybe you are struggling to refine your entries and maximize profits. Today, I'm about to break down a simple yet powerful smart money concept strategy that will help you take high probability trades with precision. Stick with me till the end because I'll share a secret tip to avoid common traps in the market. Let's dive in. So, the first thing is to understand market direction. Understand market direction. So, in this, we have three main market directions. Let me clear this so that I can show you. We have an uptrend market. We have a downtrend. And we have a ranging market. An uptrend market is where you have a series of higher highs and higher lows. Higher high, higher low, higher high, higher low, higher high, higher low. So if you see this kind of market structure, you know definitely that's an uptrend. So in downtrend, so you have a series of lower highs and lower lows. Lower high, lower low, lower high, lower low, lower high, lower low. So those are this is the uptrend and the downtrend. In ranging market, the third type of market structure, most people call it a consolidation. Is where the market has no clear direction, you see. In this type of market, you can see the market is consolidating within key areas of support and resistance. This is resistance and this is support. And the third tip is mark the recent break of structure. After identifying the direction of the market, you have to mark the recent break of structure. Like in an uptrend, let's draw a structure of an uptrend. If you see a series of high highs and high lows, if you see such kind of a market, you have to mark the recent break of structure. Like this was the higher high, higher low, higher high, higher low, higher high, higher low. What do you mean by break of structure? A place where the previous higher high was broken to form a new higher high at this point. This is what we call a break of structure. Let me draw a clear structure. You see, this was the higher high, it was broken to form a new higher high. At this point where the market was broken, it's what we call a break of structure. That's what we call a break of structure. After understanding this, you mark it, but you mark the recent one. Like let's say this is the one, this is the recent break of structure, BOS. This is where we mark. In the bearish kind of market, this is the break of structure. If the market is heading downward, if the market is heading upward, this is the recent break of structure. The third thing to note is to mark the demand zone that caused the break of structure. Let me delete this. In an uptrend market, I want us to mark the demand zone that led to the break of structure. Now this is the recent break of structure. We mark the demand zone. The demand zone is the last move that led to this break of structure. In this case, since this is the move that led to our BOS, that's where we will go to mark. So the last few candlesticks that led to the break of structure. So this will be our demand zone. In bearish scenario, where the market is heading downwards, this is the recent break of structure. So the last move that led to this break of structure is this one, and that acts as our supply zone. In an uptrend, this is our demand zone. In downtrend, this is our supply zone, and that is the third key factor to consider. The fourth key factor to consider is mark the liquidity and check for if there is an imbalance. Now, in an uptrend, have to mark for to have, so this is on a higher time frame. If you zoom to lower time frame, this is our demand zone. If you zoom for lower time frame, you will find a series of, market can't move in one straight line, so it has to come and retest. But if you zoom to lower time frame, you will see these zones. Now these zones is where we call the liquidity. If you see this zone, the liquidity ones, let me draw a clear one. This is the higher time frame, but in lower time frame, you will see something like this. Now this is what we call our liquidity zone. This is our demand zone. And if you see areas which are not filled within the market, let me draw this one. If you see this demand zone, then you see liquidity in lower time frame, and the last thing you see areas which are not filled. They are called the fair value gap or the imbalance. This is a very important thing to note. And the fifth thing is wait for the price to come back to the demand zone. After marking our demand zone, let us draw a clear structure. After marking our demand zone, this is the BOS, break of structure. This is our demand zone. After marking this demand zone, let me at least extrapolate it. After marking this as our demand zone, let me draw a clear structure. Let me draw a clear one. These are demand zone. After marking that zone, then on lower time frame you see there is a liquidity and then an imbalance. You wait for the market, wait for the price to come back to the demand zone. So we wait for the price to come to the demand zone. That's what I'm trying to say. After the price has reached our demand zone, our next point, which is number 6, go to lower time frame, that is either 15 minutes or lower, and wait for a change of character. What do I mean? Let's see. After zooming to lower time frame, you will see something like this. After tapping to this zone, our demand zone, you will see a change of character. Let me draw a clear structure. I think this is for our time frame, but after zooming to lower time frame, you'll see something like this. After price hits our demand zone on lower time frame, wait for a change of character. If the price bounced back, this was lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. After forming this lower low and hitting our demand zone, you wait for the market to bounce off this zone. And what did the price do? It bounced and then it broke the previous lower high. After breaking the previous after breaking the recent lower high, that's where we mark something called change of character. That's what we call change of character. Let me now draw a clear structure because you have understood. Yeah. After this change of character, what do we do? Now you mark the last move that led to that break of structure. After breaking this structure, we call it a change of character, abbreviated as CHOCH. So, after you see this break of structure from the last lower high that was broken, you wait for the market again. You mark a demand zone within the lower time frame. You will see a demand zone within the lower time frame. After seeing this demand zone, you wait for the price to come back and tap it. That's what we are saying. Next, mark for the lower time frame demand zone, initiate the trade and target the higher highs. What do we say? After marking the demand zone on the lower time frame, you wait for the price to tap it. After this change of character, there was formed a demand zone. This is the demand zone. Now you wait for the price to come and tap this zone. Once the price taps this zone, you enter your trade. Then you place your stop loss some few pips beneath the previous demand, beneath the demand zone. Then you target the previous high of the higher time frame. I hope it was easy and you have understood well. But before I end, so let me repeat your entry. After marking the lower time frame demand zone, you wait for the price to tap it. This is your entry. You enter, then you place your stop loss some few pips below it, and then you target the highest point of the higher time frame where the market had reached. And that's how you take a trade using smart money concept. Follow these steps and you'll start seeing major improvements in your trading accuracy. If you found this valuable, hit the like button, subscribe for more high quality trading content, and let me know in the comments which part of this strategy you want me to break down in detail next. See you in the next one.